Good afternoon. Thank you for joining today's discussion on the new age of American infrastructure. My name is Josh Feinstone. I'm a senior legislative analyst here at Venable. Joining me today are two of my colleagues from the Venable Government Affairs team. Our bipartisan team provides substantive strategic counsel and impactful representation of your interests before the administration and Congress. Today, my colleagues and I will be discussing the two infrastructure proposals put forth by President Biden, the American Jobs Plan and the American Families Plan. I would like to introduce my colleagues joining the conversation today. Utilizing her strong network in Congress and the executive branch, Sarah Donovan advises corporate and nonprofit clients on a wide range of legislative and regulatory matters. Sarah regularly engages members of Congress, staff, and other officials on a variety of issues, including education, privacy, appropriations, financial services, small business, and healthcare. She also advises clients on congressional strategies and the legislative and regulatory process. Sam Olchek leads the tax and retirement policy practice at Venable. Prior to joining Venable, he spent nearly 9 years with the congressional tax writing committees, serving as a tax counsel with the Senate Finance Committee and then a legislation counsel with the Joint Committee on Taxation. To start us off, I would like to invite Sarah Donovan to present a detailed outlook on these two plans for us.
Thanks, Josh. Sorry, I had a little trouble unmuting myself. I'm happy to be with you today. As Josh mentioned, I'm a senior policy advisor in our legislative practice group with Sam Olchek and Josh Feinstone, and I'm very pleased to be here with you today to talk about an overview of President Biden's proposals on infrastructure. And we'll talk a little bit about what that might mean in terms of process, how the Congress may proceed with these proposals. And then we'll talk a little bit about some factors you should consider as you're thinking through these for your organization. But I'll do that before I turn it over to Sam to go through a detailed analysis of the offsets that have been proposed by the Biden administration. So let's just start off with what we can learn from the first 100 days of the Biden administration and some lessons from the ARP, the American Rescue Plan. So we sort of set the stage with the losses by Republicans in the Georgia Senate races. And that means that by and large, Republicans are sort of cut out of this process, that Democrats don't necessarily need them to go along with these bold proposals that they've put forward. And we saw that with the ARP. We saw that Democrats can really achieve anything they can marshal the political will for, assuming, this is a big but, they can keep their entire caucus together. And that means everyone from AOC and Bernie Sanders to Joe Manchin, who's obviously within the Democratic Party at the opposite end of the spectrum there. And as I mentioned, that we saw that with the American Rescue Plan, President Biden can pass trillions of dollars in spending. But I think there are a few important factors that we should keep in mind as we compare this to the current proposals. One, this was the fifth kind of coronavirus omnibus bill. There were, depending on if you count the PPP policy changes and extensions, there's 8 total. But if we're talking about these big policy bills, there's really 5 of them. And the first 4 were done with bipartisan support. So that's an important thing to keep in mind as we're setting the stage for the current political environment. 2, the public was fully on board with the ARP. It was wildly popular. Voters were demanding it. And enjoyed broad support across the country. And the third thing is that there were no pay-fors, there were no offsets. So there were no hard choices when it came to, well, should we do this at the expense of this other thing? And Sam's going to talk more about those pay-fors and those offsets a little bit later. But we weren't really paying for the ARP at all. And then the other thing that I would offer is that infrastructure, generally speaking, is a different ballgame. We can best understand the proposals that the Biden administration has put forward through the lens of this is their fulfillment. This is the fulfillment of his promises Build Back Better. It's their sweeping economic recovery and job program. And they're meant to seize this rare, once in a generation opportunity to enact these reforms. And this is really how they've described it as well. They know they have this opportunity and they want to really use it to make some changes that they have desired to see for some time. Infrastructure, we can assume, will be part of this coming package or packages, and we'll talk about whether or not there may be more than one later on. And the concept of infrastructure investment will be used to both propel and then ultimately sell this politically. So that's really going to be the thrust of it, even though there's a lot of other things that are included. The current conversation is really centered on priorities that Democrats, as I mentioned, hope to enact this Congress. So there's really a conversation happening within the party as well as externally on what they're settling their priorities and what needs to actually move with precise structure. So vehicles and how many and timing are to be determined. So just to recap, there are two proposals that the Biden administration have put forward. One is the American Jobs Plan. This is your traditional infrastructure paid for by corporate and international tax increases. And it includes things like transportation and community infrastructure, research and development, manufacturing, workforce development, elder care. This is the elder care. By that, we mean this home care construct that they've discussed. And then the second one is the American Families Plan. This is what we're referring to as the human infrastructure. And this is paid for by tax increases as well on high-income individuals, estates, investors, so transfer of an estate from one generation to the next, things like that. This has education, which includes everything from a large pre-K proposal all the way through some pretty ambitious higher education proposals, family support, workforce support, and this includes paid leave, some tax changes, like with the child independent care tax credit and the child tax credit. So this is really focused around people, whereas the other one is mostly focused around things and institutions. Senate Republicans have countered their opening bid, I guess you could refer to it as, with an infrastructure package. And this is meant to serve as a counteroffer specifically towards the American Jobs Plan. And this is what's being discussed actually this week, tomorrow, at the White House with a group of senators and the president. And, you know, this is not firm by any means, but this is sort of their opening offer. And it really emphasizes spending on traditional infrastructure, roads, bridges, those sorts of things. And it also includes water and broadband, which all of these things have vast bipartisan support. There are a few key differences. Obviously, the price tag is wildly different. It doesn't have the sweeping policy changes that the president's plan does. And it doesn't change. There's no offsets. Well, that's not true. There are offsets, but they're not the same ones that change the tax code that the president's plan does. Some things to consider. Democrats broadly oppose the plan, not the least of which is because it has a substantially smaller price tag and has a lot less spending in it. But Biden is currently working to reach a bipartisan agreement on this. And there is talk in the Senate of the Senate possibly passing by regular order a bipartisan infrastructure package, maybe around highways. So this is kind of what's going on at the current moment, but let's get into it a little bit more. I think that we're in agreement that while there's current bipartisan discussions taking place, we are putting a low probability on those ultimately being successful. And then regardless of whether or not they're successful, probably this just would buy down the cost of and narrow the scope of what we expect will be a partisan package to come across Congress's desk later in the year. So the question on everyone's mind is, will Democrats use reconciliation to pass infrastructure? And we have to think about a few things as we talk about this. One is that President Biden and most of Congress is really looking at the lessons learned from their experience processing the Affordable Care Act in 2009 and 2010 during that narrow window where they had a filibuster-proof majority in the Senate. They have to do what they can while they can do it. We saw this with Senator Kennedy when he passed away. Democrats had a filibuster proof majority. And when he passed, all of a sudden they were sort of left with what they could do given the circumstances. So the House had passed a much more ambitious bill. And the Senate had processed something that was less so. And so all of a sudden they were in this situation where they had to kind of do what they could do. And that narrowed what it was not as ambitious as I think that they had originally thought they could achieve, because they thought they had more time. And the House and the Senate are both operating on these paper thin margins right now. So there's absolutely no room for error. If anyone misses a day, misses a vote, gets sick, and not to be morbid, passes away, I think the New York Times put a whole piece out on this, then it blows up the whole game. So they have to do, the time is of the essence. And then anything they hope to achieve beyond status quo, and by that I mean funding the government, these reauthorizations, it's going to have to be done on a partisan basis, just given the political environment that exists on the Hill and actually amongst the general public right now. So therefore, budget reconciliation becomes the most obvious tool at the majority's disposal, barring any significant changes to Senate rules. So barring any changes to the filibuster, this is really the most powerful tool that the majority has. So to answer the question that I originally posed, yes, we believe that Democrats will almost certainly use reconciliation again to enact their priorities. It's just a question of size and scope at this point. Some additional issues to consider. Despite its popularity in the abstract, everyone likes to talk about infrastructure and it polls very well. It's deceptively a tough issue. And it's hard to agree on a definition of what infrastructure means, let alone craft consensus policy, right? So that's the first thing is, yes, it's theoretically very popular, but it's really hard to define it. And the current conversation in practice is ranging from roads and bridges, these things that we often think about as infrastructure, to health and equity and community infrastructure. So we haven't really nailed down what infrastructure means. And it's very tricky to pay for. I mean, this is a chronic problem where we don't have really sustainable financing mechanisms for infrastructure, even conventional. And this is just during ordinary times. The lack of offsets, as I described before with the last COVID-19 package with the American Rescue Plan, made that much easier. But Democratic senators, not all of them, but some, have indicated that they intend to pay for, in some part, future bills. So that really eliminates that Christmas tree type approach that we saw in March earlier this year. And then another thing, and then I won't do too much of a deep dive in reconciliation, but we should have the knowledge that reconciliation really limits the legislative range of motions that Congress has, as we saw with the American Rescue Plan. It's really a process that's built for tax overhauls, changes to the tax code, tax and spending. That's really what it is. Changing revenue levels. It doesn't really lend itself towards policy changes in non-budgetary policy. And we have to remember through all of this that paper thin majorities, these razor thin majorities in both the House and the Senate, require a near absolute consensus of the majority, which is very difficult to achieve. So, like I mentioned, I won't go through the budget reconciliation mechanics, but as I mentioned before, the budget reconciliation really provides the Senate with the ability to fast track certain types of legislation with only 51 votes to overcome that 60 vote threshold of the filibuster to move forward. And something to consider, reconciliation can be used at least once per fiscal year. The slide used to say at least, it used to say once per fiscal year, but given the intelligence that came out of the Senate, where the Senate parliamentarian may have opened the door a little bit to interpretation where you could revise previous budgets, it may be that we can do it more than once per fiscal year. That may or may not be what they end up doing, but that's kind of the takeaway, I think, from this, is that it's a once or possibly more than once per fiscal year. And then the other thing that I would offer is that budget reconciliation entails much stricter rules in the Senate. This is due to the Byrd rule. So the House can kind of pass whatever they want. We saw that with the American Rescue Plan, but then it's the Senate where they really have to take a stricter eye to what the contents of this bill in order to process it. So what happens now? What does all this lead to? Most activity by Congress on this is going to be in flux pending the release of the president's budget, which we anticipate possibly the end of May. This president's budget will provide top-line spending numbers for appropriators to begin the annual government funding process, which is important, but it's also going to reveal additional details on the infrastructure proposals that the White House has put forward through the American Jobs and the American Families Plans. And Treasury should release its Green Book at the same time, which will give more details on the offset portions that Sam is going to discuss. There is a forcing mechanism in all of this, and that's at the end of September when our current surface transportation authorization expires. Although, as we've seen in years past, Congress could kick the can, as so to speak, and give itself a little more time to come up with something. And that deadline is actually converging with the government funding deadline for appropriations. This is September 30th as well as a debt limit. So one thing that you should think about is that the Highway Trust Fund its revenue stream has been hit hard by the pandemic. And there is bipartisan support for surface transportation reauthorization. So theoretically, like I mentioned before, we could process this by regular order. But will that happen? Will the political factors make that possible? So will Republicans play ball if they think they're going to get smacked in the face with a highly partisan, enormous package shortly thereafter? Are they just doing the Democrats a favor by lowering the number of the package that's ultimately passed via budget reconciliation? And another thing to keep in mind is, do the bird rules that I mentioned earlier. It's really tricky to do Highway Trust Fund within the scope of budget reconciliation because general transfers are not allowed to the Highway Trust Fund, are not allowed under the bird rule. So it is a very tricky situation politically and process-wise, what's being set up here. So let's talk about a few more wild cards besides this convergence of all these different things at the end of September. Obviously, the global pandemic is going to affect all of this. It's going to be all this is happening with the backdrop of COVID-19 still being active in this country and across the world. So what's the trajectory of the public health crisis? Do we have a leveling off because people are, we have some holdouts for the vaccine, or do we see our cases bottom out and we can return to normal? Do we have these variants that pop up that give us, additional crises around the country? Same thing with economic data. This is a huge unknown. And by that, I mean jobs numbers and GDP growth. We just had some very surprising numbers come out. We don't know what the trajectory of the economic recovery is going to be. Wall Street got this one wrong, and it could be that these numbers are eventually revised upwards. But we're not sure how the economy is going to behave here. I talked before about the health and attendance of Congress. I mean, I cannot stress this enough. There is zero room for anyone to be sick or to not show up. That in the House, I think it's about 3 right now. Kind of depends on the day, but there's zero room for error in the Senate. So this is a critical thing for everyone to factor in. There's also, and this is probably the big one, midterm election pressure. There's a few pressures that are related to the midterms. One of them is this narrowing of the window of likely action. It's likely confined to this year. And why is that? Well, we're probably not going to raise taxes in an election year. That'd be wildly unpopular. And because of that, it is probably going to limit how many infrastructure packages there could be. So is there the time to process more than one? Is there even the political will to process more than one? Probably not. We're probably looking at a single package, and we're probably looking at the fall. It's hard to see based on the timing for Congress to actually get this done by September 30th. Probably more likely is that it happens a little bit later in the fall. but I think we expect to see something in this calendar year. And the other midterm election pressure is, what do members of Congress need? What do these individuals need? So we're talking about the salt politics of these high high tax income tax states and what they're demanding. There's a contingent of them, especially in the House. In the more rural states, the tax treatment of family farms. I mean, these are real issues that are going to matter to these members' constituents, and they're under pressure to make sure that their constituents are not harmed by whatever it is that Congress does. And so that's going to affect what could be included and what's possible for this infrastructure package. So I think that I've done plenty of talking. And with that, I'm going to turn it back over to Josh to introduce our partner, Sam, and happy to take any questions at the end. Thanks.
Sarah, that was fantastic. Thank you so much for giving us kind of a lay in the land as to where we're going, what it looks like, and how difficult it might be to piece together something like this. Before we turn to Sam, I wanted to make sure that everyone had today's CLE code. It is Investment 2021. A CLE submission form will be mailed to all registrants sometime next week. Now, Sarah laid out what is going on from a policy perspective. The other side of this is how they are going to offset the cost of doing all of this. And to discuss all of that, I'd like to bring in Sam Olchek. Sam, can you please walk us through your presentation on how Congress may look to offset these massive proposals by the administration?
Sure, Josh. Hello, everyone. Infrastructure legislation is about the 3 Ps: policies, process, and pay-fors. Parts 1 and 2 of this infrastructure series cover the first P, infrastructure policy, and Sarah has covered the process. So I'm going to cover the last P, the pay-fors. As Sarah said, President Biden has released 2 detailed fact sheets with 16 significant revenue-raising proposals. The first batch were included in the Made in America tax plan that is part of President Biden's American Jobs Plan, or a traditional infrastructure package. The second group of offsets are included in President Biden's American Families Plan, or the Human Infrastructure Package. According to the White House, the proposals, the 16 proposals collectively, are projected to increase revenues by over $3 trillion in the next 15 years. The slide deck outlines in very broad terms these major proposals. I will walk through them, but I will really focus on the policies and the politics that underlie each proposal. And I'm also going to rank each proposal as likely to be included in the package, possible to be included, uncertain, and unlikely. So I am starting with the Made in America tax plan. These are the 8 provisions that the Biden administration has dedicated to offset the cost of the $2.25 trillion traditional infrastructure package. You see here the corporate tax rate. You see 4 provisions that involve the taxation of cross-border transactions. You see a minimum tax on book income, repeal of fossil fuel investments, increased IRS enforcement. The one thing you don't see in this slide is any mention of individual proposals. The White House did not want to conflate individual proposals with this package, given how recent the COVID relief package was passed. Next slide, please. Okay. The White House appears to assume that there are going to be multiple packages with separate offsets for each package. I don't see it. I agree with Sarah's analysis that moving multiple proposals seems exceedingly difficult from a political standpoint. In my view, the size and the scope of the revenue offset package boils down to 2 decision points. The first, how much of an infrastructure package can be offset with more government borrowing, i.e. no offsets? Second, how far will fiscally conservative Democrats, and Sarah has already mentioned Senator Joe Manchin, I would put Senator Kirsten Sinema, and there are others. How far are they willing to go? And we're going to see that impact in the first proposal, the corporate tax. Next slide. The largest revenue offset in this package is increasing the corporate tax rate from the current 21% rate to a 28% rate. President Obama proposed a similar 28% rate back in 2013 when the corporate tax rate was 35%. The key point here is Senator Manchin. He has indicated that he is willing to support up to a 25% rate, but he would not support any rate increase in excess of the 25% rate. I think it's very interesting that the 25% rate was proposed in 2016 by Senator Rubio, as well as Governors Christie, Bush, and Kasich during their presidential campaigns. Another factor that will impact the corporate tax rate is the current inclusive framework, the OECD and the G20 efforts to adopt a global minimum tax. That will weigh heavily on how high this corporate tax rate can go. So I promised that I would rank these. I view a 25% corporate tax rate as falling into the possible category. Next slide. Okay, so now we're going to begin with a heavy dose of the cross-border revenue proposals. The first one being reforming the global intangible low tax income, or the GILTI regime. So for those of you who don't spend a lot of time in the international tax space, the GILTI rules are designed to impose a current U.S. tax on income that is treated as intangible income earned by U.S. multinationals overseas. This was enacted in 2017 as part of the Tax Cuts and Jobs Act, when the United States shifted from a territorial system, from a worldwide tax system to a territorial system. And the GILTI regime is one of the rules that's designed to protect the U.S. tax base. President Biden's proposal focuses on three aspects of the GILTI rules. I won't go into the detail. I will say that in my view, the changes to the GILTI rules fall into the likely category. And I say this for two reasons. The first is that these are very complicated rules and difficult to explain. So if you are supportive of these proposals, complexity is your friend. The second, for those of you who are old enough to remember longtime Senate Chairman Russell Long from Louisiana, he had a favorite expression: don't tax thee, don't tax me, tax the man behind the tree. And that's what this would accomplish. This raises about, it's been estimated to raise about $400+ billion over 10 years. So this is a pretty significant offset. Next slide, please. The modification of the foreign derived intangible income, you will hear it referred to as FDII. This is designed to provide an incentive for U.S. companies with foreign intangible income to provide those sales or services from the U.S. So think of it this way. If GILTI is the stick, the FDII deduction is the carrot. And that carrot takes the form of a 37.5% deduction for a domestic corporation's intangible income that's attributable to sales or services to overseas customers. The President Biden's plan calls for its repeal. with the revenue to be used to offset certain R&D incentives. My view is that the R&D incentives are likely to be included in this package, but I think the repeal of the FDII deduction is going to be more challenging. So I have ranked this in the uncertain category. Next slide. The BEAT, base erosion and anti-abuse tax. This is another key aspect of the cross-border base protection mechanism that was enacted in 2017. Think of this as applying to deductible cross-border payments from a U.S. entity to a related foreign entity. So, for example, if a U.S. company borrows money from a foreign parent or a foreign entity, those interest payments, those cross-border deductible interest payments would be considered a BEAT payment. And what the BEAT rules provide is essentially a alternative tax regime where a U.S. corporation pays either the higher of its regular tax or its BEAT tax liability. President Biden's plan calls for a wholesale replacement of the BEAT rules. Senate Finance Committee Chairman Wyden recently issued a white paper on international tax reforms, and it includes a more modest proposal that would increase the tax rate that would apply to these BEAT payments. In my view, the Senate Finance Committee's the white paper proposal falls into the likely category. Next slide. The American Jobs Act plan includes, or it supports the current efforts undertaken by the OECD and the G20 to enact a global minimum tax. And if the U.S. corporate tax rate is going to be increased, a global minimum tax will be important to discourage the emergence or the reemergence of the inversion phenomenon where U.S. companies move their headquarters overseas. This is the inclusive framework involves over 130 countries, and trying to get these countries to line up behind a global minimum tax is going to be very challenging, particularly with respect to Ireland. The key time frame here, the next key time frame is mid-July, where the G20 finance ministers are going to be meeting. This does not require any congressional activity at this time, so I'm not ranking it. Next slide, please. A minimum tax on book earnings. President Biden's proposal includes the imposition of a minimum tax on corporations that have at least $2 billion of net book earnings. And it is estimated that about 180 companies would fall within this category. Some members of Congress and supporters of this refer to this proposal as the Amazon tax. Now, this is not a new idea, and this is not a new issue. For those of you who remember the 1986 Tax Reform Act, the corporate AMT rules after the 86 Act included a book income adjustment. Well, that lasted all of 3 years. It terminated in 1989. There's a fundamental misunderstanding regarding the accounting rules and the tax rules and how they accomplish very different objectives. And because of that, the income is measured very differently. But that seems to is not well understood on the Hill. I would rank this proposal somewhere between uncertain and unlikely. Next slide. The Biden tax plan calls for the elimination of all fossil fuel tax incentives. This raises a fraction of the revenue. I guess relatively speaking, this is less than $40 billion over 10 years. President Obama included this in his 2010 budget. I view this as I view this as falling within the unlikely category. Politically, this is going to be very difficult. There are a number of Senate Democrats from significant oil and gas producing states that would be hard hit by this. I think the recent cyber attacks on the Colonial Pipeline, the spike in oil prices, given the fact that this raises a relatively modest revenue in comparison to the entire cost of the package, I don't see this happening. Next slide, please. Increased IRS enforcement efforts. The Biden administration has indicated that it would like to increase IRS funding by $80 billion over the next 10 years. I certainly believe that the IRS budget will be increased, and I think that it will be the increase will be significant. But it is going to take years to build up IRS enforcement and training. At a Senate Finance Committee hearing yesterday, there was an IRS official who indicated that, who testified that it takes about 3 years for a new IRS enforcement person to be trained up and to be efficient. So I put this in the likely category, but it will be a much less robust revenue estimate than the Biden administration projects. Next slide. Okay, so that concludes, those are the 8 revenue offsets that are being earmarked for the traditional infrastructure. What I want to turn to next is the 8 offsets that the administration has identified for its American Families Plan, or what I call the human infrastructure package. And you see that these are all related to individual taxes. And I've put them in, I see them as falling into 4 categories: individual, real estate investments, increased reporting, and Medicare. Now, this package creates very different dynamics than in the first package. And Sarah alluded to this in her presentation. There are 2 issues as I see it. The first one is the impact on small businesses. And the second is the political split that is caused by the $10,000 limit on state and local taxes, the so-called SALT deduction. A very interesting factoid: of the 40 congressional districts with the largest SALT deductions, 39 are represented by Democrats. Several House Democrats have already indicated that they won't support a package that doesn't include a repeal of the SALT limitation. But that costs about $80 billion a year, and 50% of the SALT benefit goes to taxpayers with income in excess of $1 million. So this creates some real political issues for House Democrats. Next slide. Again, these are the offsets that relate to the American Families Plan. I think perhaps the most significant point in this slide is the last bullet point. This package is designed to ensure that no one that is making less than $400,000 will see their taxes go up. Next slide. So we start with the proposal to increase the maximum income tax rate on ordinary income. The proposal is to increase the rate from 37% to 39.6%. You see here, the administration has already announced the thresholds, 523,000 plus for a single filer, 628,000 plus for joint filers. I think it's important to note that the 37% rate, which was enacted as part of the Tax Cuts and Jobs Act, automatically snaps back to the 39.6 when this expires at the end of 2025. I put the rate increase in the category of possible. Next slide. The other individual rate category proposal has to do with the capital gains rate. The Biden plan, the Biden proposal calls for increasing the maximum tax rate on capital gains from the current 20% rate to 39.6 for taxpayers with incomes in excess of $1 million. As I see this, if there is going to be an increase, the rate increase will be much more modest. I think it'll be around a 28% rate. This is truly a budgetary exercise. The question is, what is the optimal rate that will allow for maximum revenue from capital gains? The University of Pennsylvania Wharton business model released its projections that the Biden proposal, the 39.6% rate in and of itself, would result in a revenue loss because taxpayers would instead hold on to these appreciated assets until death. So in order for this proposal to raise revenue, it has to be coupled with the repeal of the step-up in basis, which we'll talk about next. So if I had to rank this, I would say that increasing the capital gains rate to 28%, I put that in the possible category. Next slide, please. Perhaps the most intriguing proposal here and the most politically challenging is what to do about the repeal of the step-up in basis. This rule has been in the tax laws for 103 years. The Treasury Department in 1918 issued regulation that says that the appraised value of property at death is the basis for determining gain or profit upon a subsequent sale. So we are talking about overturning 103 years of precedent. When candidate Biden proposes during the campaign, my initial reaction was that this would not go anywhere, and this would instead be replaced by a reduction in the lifetime exclusion amount, as well as a proposal to increase the estate tax rate. But the White House has apparently backed away from the other two estate tax proposals and is now focusing exclusively on repeal of the step-up in basis. So given its interaction with the capital gains rate, I have to put this in the uncertain category. Next slide. Okay, now we are going now to the proposals that are really targeted at commercial real estate. And the first one is the carried interest, what is referred to as the carried interest. This is not a revenue issue. I mean, or I should say it's more than a revenue issue. The revenue that this raises is less than $10 billion over 10 years. This is viewed more as an equity issue. And there are strong feelings among many Democrats that this has to be addressed. And what was done in 2017 didn't go far enough. In my view, if the capital gains rate is not increased to 39.6, which again, I don't see that happening, there's going to be a strong push to tax carried interest as ordinary income. So I would put this in the likely category. I think that this is going to happen. Next slide. The second proposal that really primarily relates to commercial real estate has to do with the curtailment of the like-kind exchange rules for real property. To me, this is very similar to the carried interest proposal, at least politically, in that this is much more than just a revenue issue. This, again, raises less than $10 billion over 10 years. What this proposal would do, the Biden proposal would eliminate the deferral that currently exists for like-kind exchanges of commercial real estate, subject to a $500,000 exception. Many Democrats believe that this should have been done in 2017 and would have been done, but for President Trump's relationship with the commercial real estate industry. So I view this as falling between the possible category and the likely category. But I also think that the $500,000 limit could be further increased. Next slide. This also is the third tranche of the real estate proposals. This has to do with making permanent a loss disallowance or a loss deferral rule for non-corporate business losses. This was enacted in 2017 as part of the Tax Cuts and Jobs Act, and what it does is it limits pass-through losses for non-corporate investors to $500,000 for joint filers or $250,000 for individual filers. Now, this was, as when it was passed in 2017, it was initially scheduled to sunset after 2025. The American Rescue Plan that President Biden signed into law 2 years ago extended it for 1 year. So it is now set to expire at the end of 2026. That 1 year extension resulted in a revenue estimate of $31 billion. I think I would put this in the likely category. Next slide. The Biden proposal includes the Biden package includes a proposal that would require enhanced reporting for financial institutions. This reminds me of the 2010 enactment of the Foreign Account Tax Compliance Act. You hear that referred to as FATCA. That was based on a 2009 Senate investigation that says the United States loses about $150 billion a year due to offshore tax schemes. When the Joint Committee on Taxation estimated the 2010 FATCA legislation, the increased reporting was estimated to raise a little less than $10 billion as opposed to over 10 years. The Biden administration seems to think that this will raise in excess of $300 billion over 15 years. I put this in the likely category with a much lower revenue. Next slide. The last proposal involves the expansion of the Medicare tax. Now recall that candidate Biden called for the elimination of the Social Security wage cap for taxpayers who earn more than $400,000. As Sarah said, this cannot be done under reconciliation. It is a violation of the Byrd Rule. So the administration is now pivoting and saying that there should be a consistent application of the 3.8% Medicare tax. I think that means that applies to distributions from S corps. My question about this offset is the following. If this offset is used to pay for more spending, how is Congress going to shore up the Medicare Trust Fund, which is projected to be insolvent in 2024? I put this in the uncertain and maybe even in the unlikely category. And I'll just say uncertain. So that's it. That's how I see these proposals, and that's how I would rank them. At the end of the year, Josh will let me know how I did. Josh, the only thing I would say is that remember that in baseball, a 300 batting average is considered Hall of Fame material. So I would ask you that you judge me on a similar scale.
No, that's great. Absolutely. And I'm sure, Sam, you've gotten much more of this right than you'll get wrong, seeing that you're quite the expert here. And I think you've forgotten more about tax policy than most of us will ever know. So certainly appreciate that robust explanation of what's going on. I want to bring Sarah and Sam back in as we ask a couple questions here and look to wrap up. While both of you were presenting, the four corners of leadership, Speaker Pelosi, Senate Majority Leader Schumer, Senate Minority Leader McConnell, and Minority Leader McCarthy were all at the White House speaking with Biden about a path forward on these exact issues. And the Republicans left the meeting with a red line on not reforming the 2017 tax changes, but ultimately it looked like they were very positive on trying to find some path forward. Sarah, taking that into an account and then also blending in one of our attendees' questions, I have a two-parter here. Knowing everything that you've said today, how do you think these policies will be enacted and move through the legislative process? And in your answer, would you clarify for one individual who asked that do we see moving an infrastructure package plus a surface transportation bill, or is it one or the other, or how will that work?
Those are really good questions. I think that these are what Congress is trying to work through right now. So we're operating under the assumption that they will continue to work on processing a bipartisan surface transportation bill until that process falls apart, which may very well happen. So at which point they would pivot to a Democrat-only budget reconciliation process that would include these surface transportation aspects to the extent that they are able to under the Byrd rule in the Senate. So I think that I don't necessarily have a black and white answer for the person that asked the question, because it's really not known. This is what they're working through in real time, and they're trying to figure out how to balance the politics and the policy and the process all at the same time. So I think the first thing you asked was how will they process all of this? Oh, was that what you said, Josh?
Yes.
Yeah. So I think, that I would say the same thing there too. So, getting into more specifics, will there be one or two bills? If I had to put on my betting hat, I would probably say one. Mm-hmm. But this is all being decided and negotiated as we're sitting here speaking today.
Yeah, I know it absolutely feels like it's all happening in real time. And I think you're absolutely right that there's some elements of the surface transportation bill that are not ripe for reconciliation. But it sounds like what you're saying is they will go along with this process of a bipartisan path until that doesn't become a path forward. And then they may revert back to reconciliation. Is that sort of?
That I agree with you.
Okay. All right. Sam, if they were to move forward with some of these offsets, and these are incredibly significant offsets that are going to raise millions and billions of dollars, when would the offsets take effect? Would they do it retroactively?
Oh, you sound like a client, Josh. Well, certainly Congress has the authority to do it retroactively. In fact, in 1993, when President Clinton increased the maximum tax rate from 31 to 39.6, it was signed into law in August, but it was August of 93 and it was made retroactive. Having said that, as this process continues, and I think Sarah said it, I don't see a bill coming to fruition until after, in the fall. There politically, it becomes very difficult to do this retroactively. My guess is that most of the proposals will take effect 1/1 of 2022. Perhaps some of the proposals that are transaction specific, they might take effect on date of first committee action, but on rates in particular, I think it'll be 1/1 of 2022.
And following up on the corporate tax increase, we had a question from the crowd here. Is it one stop where you can either go from 21 to 28, or is there some sort of possibility for any kind of compromise, sliding scale, start at 21, max out at 25, have the lower rate applied based on the size of your business? Anything like that, or does that get much too complicated to formulate and promulgate rules on? How are they going to get creative here at all, or is it really come down to they need to raise a certain amount of money, and once you start playing with those numbers, you drastically cut what you're actually offsetting?
As I said, I think that we'll see a 25% rate in terms of, or I think that's. I think I said it was likely. In terms of a graduated rate, we used to have a graduated system, but it was so compressed that you got to the highest rate at $1 million. So that seems to have fallen by the wayside. I think that I don't think if the maximum rate is 25%, I don't see it going from 21 to 23 to 25. I think we will have one rate, and it will apply. It will not be graduated.
Sam, one last question before we conclude today. Touching on the SALT deduction, this more than any other potential offset has really created a split amongst Democrats, especially in the House. Are they going to be able to bridge this a little bit? Are they going to be able to reach a consensus on SALT? Because based on where you live, it matters a lot. And if you don't live in the right spot, you don't care at all.
You're absolutely right. And as a Marylander, I certainly care. But I will say that this has to be resolved. The speaker will have to be, the leadership will have to be creative. My guess is that where they will end up is increasing the $10,000 cap. I would say anywhere between 50 to 50,000, maybe to 75,000, no more than that. They can't do a complete repeal. That would just undermine so much of the revenue, and it will create a lot of heartburn among the progressive members. So it'll be a compromise, and I'll say right now, probably 50 to 75 will be the new SALT cap.
Wow. Very interesting. We'll certainly watch all of this as it moves forward, and we'll definitely circle back with all of you. Sarah and Sam, want to thank you for your time today. These presentations have been incredibly detailed and very, very thought-provoking as to what may happen and why it may happen. And I'm sure I speak for all of the attendees here in thanking you for the time that you put in and the effort to explain in very simple terms what is actually going on. I think it's of benefit for all of us. And with that, this concludes our webinar, and thank you for joining us for today's discussion. A recording of the session will be available shortly on our website. The members of this panel will be responding and getting back to those that ask questions during the presentation in the coming days. We also invite you to visit Venable.com to contact our legislative and government affairs professionals if you have any additional questions. Thank you, and have a good rest of your day.